Welcome back to another video. In this video, we are going to go over the anatomy of trading. I'm going to break down what is trading. I'm going to give you guys a full trade breakdown. I'm going to give you examples of trading like a casino, trading structure, what makes prices fluctuate, and trading types. So by the end of this video, you guys will have a great idea of how we are going to trade and the proper way of trading. So first and foremost, let's get started. What is trading? So trading is basically buying or selling stocks or any financial instruments, which could be options, forex, or anything else you may trade. It's basically buying or selling to capitalize on daily price fluctuations. So the whole idea of trading comes down to this right here. So when you're trading, let's say you buy 3 shares of a stock trading at $10. So let's say stock ABC right now is trading at $10. If stock ABC right now is trading at $10 and you buy 3 shares, you buy 3 stocks at $10, let's say this stock goes from 10 to 12. You now made a profit of $2 per share, right? And since you have 3 shares, you made a total profit of $6. That is your total profit on the trade. That is the whole idea of trading. Basically buying a stock low, aiming to sell it high, or basically shorting a stock, right? Selling a stock at a high point and buying it at a low point, which is known as shorting, which I'm going to cover in the upcoming videos. Right now, obviously trading is not that simple. It's not where you just randomly open up your computer, you pick a random stock, you buy it, and it goes up, right? There's a lot of things that go behind the scenes that we as traders have to understand and evaluate before we can actually go and buy this stock at $10. Before we go and buy this, there's a few set of things that we as traders need, right? And that have to make sense before we can go and make the trade. So let's break that down. Now, before we break that down, I'm going to give you guys a simple idea. So we're going to trade very similar to a casino, right? So we're going to trade very similar to a casino. Now, a lot of traders, right, are gamblers. We're not trying to be the gamblers. We're trying to be the casino. We want to be the casino. We want everyone else to be the gambler. So how do we become a casino? How does a casino operate? And how is casinos and the stock market very similar? So let's work with a game. This game right here is called roulette. So for anyone that doesn't know roulette is a game where you bet on a number or a color, and if you, let's say, bet $50 and you get that color, you basically double your money. If you don't, you lose your money. Right? Obviously, if you bet on green, it's a little bit different. So let me break down the rules so you can implement that same set of rules and structure to trading. So casinos have this game called roulette. Roulette has these colors. We're not going to focus on the numbers. They have 18 black, 18 red, and they have 2 green. Now, usually when people play this game, they think it's a 50-50 game. They think, hey, if I play roulette, if I win, I double my money. If I lose, I kind of lose all my money. Kind of true, but what you have to understand is casinos have set this game up in a very strategic manner. This is not a 50-50 game. If it was a 50-50 game, casinos would be out of business, guys. They would not be operating, right? This is not a 50-50 game. So how's this game operate? Now, the way this game operates is casinos have a probability of 52.6% of being right. You have a probability of 47.4% of being right. So the casinos have something called an edge. Right? They have an edge. They have a 5.2% edge over you. They have a 5% edge or a 5% probability that they will be right and you will be wrong, right? So how is that edge established? So the way the edge is established, if you look here, there are 38 numbers. So if you do the math on all of these numbers, and let's say you bet on black. If you bet on black, you have 18 chances of it hitting 18, and then they have chances of 20. So basically they have 2 more rows over you. If you select red, it's the same concept. there's 20 other numbers. Now, for it to be a 50-50 game, if this number was eliminated, it would be a 50-50 game. Because now if you bet on black, cool, you have a 50% chance. If you bet on red, you have a 50% chance. Right now, you don't have a 50% chance. Even if you bet on green, you definitely don't have a 50% chance. So the casino has these two green implemented into the game because the green colors give them their 5% edge. Even if you bet on green, now you're going against 36 numbers, right? So any way you look at it, at the end of the day, casinos have an edge. Now, that's the first concept they have. They have an edge. So the reason casinos are able to make a lot of money day in and out is because they have this ultimate edge in trading, or ultimate edge on their side. That edge is very small, 5%, but this edge allows them to make billions and billions of dollars every year because they have an edge. So that's the first concept that casinos have. And that's the first concept that we want to have in every trade. So every trade we take on, and every trade that you guys ever want to take, you need to have an edge. You need to have a reason why it may go up or down, and that reason has to be extremely strong, right? That's number one. The second thing casinos have is they have risk management, right? They control their risk. Now, if you think about it for a second, for anyone that has played this game, you'll probably know the answer. If you haven't played the game, I'll give you the answer in a bit. But what do you think their risk management is? How do you think they control risk, right? We got the edge part, but how are casinos controlling their risk? The way they control risk is on each table that casinos have, they have a max bet. They have a max bet, meaning the max you can bet on this table is $100. The max you can bet on this table is $200. They do not allow you to bet more on that table. Now, why do you think they have a max bet? They have a max bet because they know that if they're wrong, the most they're going to lose is 100. Because if you can only bet $100 let's say on a play, right? The most they'll lose is 100. They understand that. So the way their system is set up is, once again, they have their risk controlled, right? They know their max risk on each transaction, and they know they have an edge. They know that, hey, we have an edge of 5%. So what that means is, if let's say they take 100 trades, right? And on each 100 trades, they know how much they're going to lose, the max they're going to lose on a trade. But before they take on any single trade or transaction, they know they're going in with an edge. Now, the reason the edge and risk management is important is because of this, right? Let's say casinos did not have risk management. Let's say they did not control their risk, which is what a lot of traders do. They don't control their risk, and you'll see how it ends up destroying you, right? So let's say casinos take on 5 transactions. One transaction, casinos make $500. Another transaction, casinos make, let's say, $400. Another transaction, casinos make $100, right? Let's say another transaction, casinos make $600, and another transaction, casinos make at $400. Now, if you do the math on these 5 transactions, the casino has made a total of $2,000 profit. Now, this looks great, but now think about this. Let's say on the 6th transaction, right? Let's say this right here is the 6th transaction. Let's say on the 6th transaction, instead of them making money, someone comes in and bets $5,000 on a color. Let's say they bet $5,000 on color black, and they get it right. What do you think happens? On one trade or one transaction, they're negative 5,000, and because of that one transaction, the casinos automatically are down 3 grand, right? Why? Because they built themselves up. It took them 5 trades to get to $2,000 profit, and then the last trade, someone came in, took a very aggressive trade or aggressive bet. They had no risk management, and the casinos did not control it, and they were wrong, and they lost money. And at the end of the day, all their 5 consistent trades or transactions went to waste. And this is what happens with most traders. They make money, 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 but they don't have risk management. And that risk management takes one bad trade, which destroys their account or brings them into the red territory again. So we as traders want to have two things involved. We want to have an edge. This is something that I want you guys to kind of like cement into your head. Every single trade we take, guys, every trade needs to have an edge. You need to have a high probability that the stock is going to go in your favor. Be it up, be it down, be it whatever the case is, but you have to have an edge. I will break down in the upcoming lessons on what we're looking for when I talk about an edge. Right, I'll break that down, but for now, I just want you to understand that there needs to be an edge in each transaction. Each trade you take, you need to have an edge. If you don't have an edge, you don't take a trade. Focus on having an edge. Focus on having a high probability of the trade going in your favor. The second thing we need, guys, is we need to make sure we have risk management. We have to make sure our risk is controlled, because we can have the highest edge in each and every single trade. But what you have to understand is one trade without proper risk management could completely destroy 10 or 20 good trades. So you need to make sure that these both are combined. That's the system casinos follow, and that generates billions of dollars for casinos. They have an edge and they have their risk controlled in each transaction. And us as traders, we want to do the same thing. We want to have an edge, and we're going to look for an edge. We're only going to take trades that give us a high probability, and then we are going to implement risk management, which I will cover in the upcoming lessons, and we are going to combine them to generate a good trade idea. That is going to give us a high probability. Now, the next thing I want you to understand about trading is all a probability game. It's all a probability game, right? It's all a probability game where do you have a high probability of the stock going in your favor or a low probability? Now, what you have to understand about the probability game is that the probability game is never, ever, ever going to be at 100%. This does not exist, right? 100% does not exist in the marketplace. There's no such thing as I know a stock is going to go up. So if you hear someone, or if you're someone that says that, eliminate that. Do not ever say, I know this stock is going to go up. I know this stock is going to go down, because at the end of the day, no one knows if a stock is going to go up or down, but you could have an edge, or you could have the probability on your side. You could have a reasoning on saying, you know what? I think this stock has a high probability of going up because of reason X, Y, and Z. Now, if the stock goes down, you have risk management implemented to protect you from the downside. But the reason I bring up the fact that trading is a probability game is because you need to prepare yourself now and understand that there will be risk and you will lose money. You will be wrong. So when you are wrong, you need to learn how to accept it and understand that, yep, it wasn't 100%. 100% doesn't exist. I was maybe 70% that it was going to go up, but the 30% took over and it didn't go up. I'm fine with that. I implemented my risk management, move on, right? So let's break down a trade. Now, let's say we have a chart. So we have a price chart. I'm going to give you guys a very, very basic example here, right? It's a very simple example. Trading is not this easy, but I'm just breaking a simple example so you guys have an idea. Let's say this is $10 and let's say this is 13. Let's say in the past few days, the stock has been hovering around 10 and 13, and it looks like this. And guys, once again, trading is not going to be this simple, so don't expect to find plays like this perfectly. But let's just say, for argument's sake, this is what we see. Now, with this set of information, right, we see that every time the stock hits 10, it goes up. Every time it hits 13, it goes down. So let's just say the next time it comes to 10, we formulate an idea and we're like, we think the stock is going to go up because of reason X, Y, and Z. That's why. So we look to identify if we have an edge. We're like, hey, do we have an edge? yeah, we have an edge. What is my edge? My edge is this, that it's gonna go up because of these reasons. I'm not gonna get into reasons yet. I'm gonna cover them step by step when we do, but let's just say the reason is that every time it hits 10, it goes up, right? Just keep it very simple. So in this situation, stock hits 10 and we have a strong edge that it may keep going higher. Now, once we identify that, we say, okay, I'm gonna buy this stock at 10. So we now set up a plan. And this is a plan that's very important. Where am I buying this stock? I'm buying the stock at $10. Okay, now is that enough? Right? Question, guys. Is that enough for us to take on the trade? We have an edge, we know where we're buying. Is that enough? The answer is no, that is not enough. Just having an edge is not enough. Knowing where you want to buy is not enough. The next thing we need is we need to know our risk. Okay, fine. I have a high probability that this stock is going to go up. What if it doesn't go up? What if it goes down? What if it does go below 10? How much will I lose? Where do I think I'm going to be wrong? Like, these things have to be looked into, which we will break down in depth once we get to it. Let's say I'm like, you know what? If this stock can get to 9, I'm going to exit. Meaning if it hits $9, I'll exit because it hasn't went to 9. Every time it goes to 10, it goes up. So if it goes to 9, that means it's not going up now. So I put something called a stop loss at 9, meaning that if the stock goes to 9, I automatically sell the stock. The platform will automatically sell for me if or when it goes to 9. So if the stock goes to 9, automatically I'm out. So at this point, I'm risking $1, right? I'm risking $1 on this trade. Now, as I'm risking $1, my next step should be, okay, does this stock have potential, right? Does it have potential to go up, right? Does this stock have potential to go higher, or is it kind of stuck at where it's at now? So I might say, you know what? I think it has potential. I think it has potential to go to 13. Once again, very basic and straightforward example. It's going to be a little bit more complicated than this, guy, so I don't want this stuck in your head, right? So it has room to go to 13. So my target to take profit is at 13, right? So I'm expecting this to go to 13. Now, a few things, right? Just to get a little more advanced, just take it up a notch. If I buy a stock at 10, that $13 mark is kind of an idea. Is it going to go to 13? Maybe not. It might go to 14. It might go to 12 and come down. It might go to 11 and come down. It might go to 10, 15 and come down. Do I know for a fact that it's going to go to 13? Absolutely not. But I know that there is room. I know that there is potential for it to go to 13 because of the information presented. Right now, for argument's sake, if this stock was trading around 1270, it still has room to go to 13. So at that point, the profit would be less. In this situation, the profit is more, but the potential is still there. So I would say, okay, so I'm risking $1 to potentially make $3. Now, let's go over the trade again. Do I have an edge? Yes, I have an edge. I know where I'm buying. I know where my stop is. I know where I'm going to exit if I'm wrong. I have my risk management. And the trade actually has money to be made, right? Because now I might have my buy order. I might have my risk management in place. I might have an edge, but the stock may not have any room to make money. So it's not a good trade. These things have to be considered, guys. You have to pay attention to this, right? So now this trade looks great. Now, if you look at this trade, I'm risking $1 to make 3. Now, let's do the simple math on that, okay? So I have a 3-to-1 ratio. What that means is I'm risking $1 to make 3. So every trade I'm potentially right in, I'll maybe make 3, and this is not actual facts. When we get to this topic, you'll see this isn't a fairy tale world where it actually hits 3 each and every single time. But just for argument's sake, let's focus on this. So now let's say I take on 10 trades, right? I take on 10 trades. Or let's make it 100. Every trade I'm wrong, right? I lose $1, right? So every trade I'm wrong, I lose $1. Now let's say out of 100 trades, I'm right on 40 trades and I'm wrong on 60 trades. Now, if I have proper risk management, the 60 times I'm wrong, I will lose $60. Why? Because I'm losing only $1 per trade, $1 per share, right? On the 40 trades I'm right? I'm making $3 per trade. So 40 multiplied by 3, I'm making $120. Even if you offset the profit to the risk, you still walk out making a profit. That is the simple concept of trading, right? Now these trades, all these trades we're taking it with a high edge and a high risk, a high reward to risk ratio, where we are getting rewarded $3 and we're risking 1. Now, if you think about it, we basically have to be right only 40% of the time, only 40 times out of 100, only 4 times out of 10 times. That's the only amount of times we have to be right to be profitable. Now, even if we're right 30 times and we're wrong 70 times, we still make money, guys. We are still green, right? Because when we're right, we make 90, and when we're wrong, we lose 70. We still walk out making $20. That is trading. It is controlling risk. It is having high probability or having an edge on your side and following your plan. It's having the solid plan that you continuously follow that generates you money, and you accept when you are wrong because you understand you won't always be right. Now, where it doesn't become a fairy tale world is when you guys do take on trades, right? Let's say I do buy a stock at 10 and I'm looking to sell at 13. It's not always going to go to 13. So I'm not always going to make this $3 per trade. Sometimes this 3 might be 2, right? It might go to 12 and might start coming down. Sometimes it might go to 11 and it might start coming down. A lot of other different roles step in, which is why this never looks or becomes a perfect scenario. It looks like one, but it never fully becomes a perfect scenario. Our job, right, this is another part of trading, is once we make the trade, we trade. And then the second concept, which is a very important concept, is managing. When we manage the trade, that's the second important concept, which we will break down in the upcoming lessons. And then when we manage the trade, we sometimes get the 3 target, sometimes we get a 5, sometimes we get a higher reward, depending on how we manage the trade, depending on what happened, and so many other factors. But the main idea of trading that I want you to take away is we are implementing solid risk management, and we are implementing a very, very strong reward to risk ratio with risk management and a high probability. Now let's look at one more example so you understand. Let's say we take the same example, right? 13 and 10. Same exact example. Stock trades around here a lot, right? Let's say now the stock gets to 1270, right? The stock is at 1270, right? It's at 1270. Now, when we look at this, we see that we have an edge. We see that the stock is giving us a very strong edge, that it's going to keep going higher. Okay, we look, it's like, wow, we have an edge. We have a high probability it's going to go higher. So we're looking to buy it at 1270. Okay, where do we take a loss? We will take a loss at a level that we're wrong. Obviously, if a stock's at 1270, sometimes we can find something here. But let's just say for this example, right, our stop is at 9. That if the stock gets to $9, right, I will take a loss. For better math purposes, let's make it 970, just so we can have an exact number, right? 970. So if I'm wrong on this trade, I lose $3. This is my potential loss, right? If I'm right on this trade, where do I take profit? Now, that would be 13, because the stock, every time it comes to 13, look what happens. It gets rejected, right? So at this point, my profit would be at 13, right? So I'm basically looking to make 30 cents, okay? So if you look at this trade from a mathematical standpoint of view, I'm looking to make 30 cents on a trade, and I'm risking $3. That makes no sense at all, guys. 0 cents. I don't care what the edge is. I don't care if the edge gives me a very high probability. The trade structure does not make sense. I should be making at least 2x of what I'm risking If I'm risking $3, I want to make at least 6 or anything above 6. If I'm risking 3, I don't want to make 3. If I'm risking 3, I don't want to make 30 cents. I want to make far more because I'm putting on risk. So this is a terrible trade, and this is a trade a lot of people get caught in. They end up buying it at $12.70, and even if you do make 30 cents on the trade, that's a terrible trade because you put on too much risk. A better trade in this situation, right, would be to wait, which is another thing we're going to cover, for it to break 13 and go higher. Because if it breaks 13, now my stop could be below 13. That's where I would take a loss. And my profit target could be at the next level of maybe resistance, or next level is having a hard time, or next profit take level, whatever it may be, right? That would make more sense. Now I would have obviously a good edge and a good risk management plan in my trading. It's a very important thing to understand, right? Now, everyone's probably like, wow, that's so simple. Have risk management, have a plan, have an edge, and you make money, right? Casinos do it, so we have to do the same thing and I'll automatically make money. Now, this is where people are wrong. Now, the reason they're wrong is, yes, you gotta have a high probability. You gotta have an edge, 100%. That's one thing we're gonna have with our structure. We're gonna have an extreme high probability. Next, we're gonna have a lot of solid risk management strategies that are implemented, right? So right here, we have the structure of a casino. Now, what messes us up is this part, psychology, right? And you're gonna see more and more. For people that have not traded, you're gonna get a wake-up call with this, right? For people that traded using real money, you know how deep psychology is. Now, the way psychology messes us up is it makes us avoid following our risk management plan. It makes us sell too early. It makes us not sell. It makes us chase stocks that don't have high probability, right? There's so many factors that play a role in the psychology aspect, right, that mess people's plan up. Our job is to develop this plan, right? We're going to develop a plan on what we're trading, what type of stocks we want to trade, what our trading style is. We're then going to develop a risk management plan, right? How much we want to risk, how much risk can we take, how comfortable am I on taking a certain amount of risk, and then we're going to understand our psychological state of mind, and we are going to use these three to develop a trading plan, and that trading plan is going to help us generate money in the market. But for us to do that, we need to have these three aligned. That's the whole idea of trading. It's having a system that basically works alongside of these three components. We want to have these implemented. So this is the first focus, second focus, and then we establish the psychology aspect. Now, what makes prices fluctuate? Right? I'm going to go more in depth with this, but prices go up or down because of a simple idea of supply and demand. Supply and demand. If there's more supply than demand, right, what happens? Prices go down, right? So if there's more demand, right, in this situation, there's more demand. When there's more demand, prices go up. When there's less demand and more supply, prices go down. So it's a simple idea of supply and demand. That's why prices go up or down in the market. Our job is to understand the reasoning behind the supply and demand concept, what causes demand to increase, what causes demand to decrease, which I will break down in the upcoming lessons. But the simple idea is prices go up or down because of supply and demand. Now, last thing before we go to the next topic is trading types, right? Like I said, we want to understand what your trading style is going to be. As we progress, I'm going to help you guys pick out different trading styles based on your risk, based on your schedule, based on a lot of things that, you know, are personalized for you, right? Because the way I trade, the way you trade, the way the person next to you trades is all going to be different based on a lot of different variables. But now, before we get there, let's understand certain trading types. The first one we have is day trading. Day trading is a method of buying and selling securities within the same day. Positions are closed out within the same day. They are taken and have no position, and no position is held overnight. So you're buying or selling a stock the same day. You buy Monday at, let's say, 10 a.m. and you're selling it at, let's say, 10:20 a.m., right? 20 minutes, sometimes an hour, sometimes 2 hours, sometimes 3, but within the same day, the trade is entered and exited, right? Next, we have something called swing trading. Swing trading is usually when swing trades are usually held for more than a day, but for a shorter time frame than trend trades, right? So this is also a range bound or sideways market is a risk for swing traders. So whenever you see a range bound or sideways market, that's a major risk for us people that are looking to swing trade. So swing trading is something where you'd maybe buy a stock on Monday and get out Wednesday, get out Thursday, get out 2 weeks from them, get out 3 weeks from them, right? So that's the whole idea of swing trading, where you're holding a stock for a longer period of time. The third, we have something called scalping. This is one of the quickest strategies employed by active traders. You take advantage of small moves that happen frequently with large size. So the idea of scalping is, let's say at 10:01 a.m., right? You buy a stock or you buy a security at, let's say, 171. At 10:02 or 10:03, you are selling it at 175. So you make, let's say, 4 cents, right? But you're buying, like, let's say 5, 10, 20,000 shares and you're profiting pennies. That's scalping, okay? And then the last one we have is called position trading. In position trading, you use longer term charts anywhere from daily to weekly in combination with other methods to determine the trend of the current market direction. So this is something where you're trading for a longer period of time. You're holding a position from months to maybe a few weeks, whatever the case is. Right, so just to recap everything, we have day trading, swing trading, scalping, and position trading. When you're trading, when you get involved and you really figure out what you want to do, you have to understand your trading style. The way you trade is going to be, the way you day trade is going to be different than the way you position trade, right? The way you scalp is going to be different than you swing trade. They're all going to have different strategies, different risk management concepts, different approaches to the market, right? So the way you analyze when you're position trading or swing trading is going to be completely different than these two, right? And this is very important to understand, because when you are trading, like I mentioned, understanding your trading style, understanding all these things about you are going to help us create a system for you. And that system is going to help you generate consistent money over and over again if it is implemented the right way and if it is tuned over and over again. Just to recap, the main concept of trading that I want everyone to take away from this video is every single trade that you take on from here on, you need to have an edge. You need to have a reason on why the stock is going up or down. You have to have a reason on why you are entering. The reason has to make a lot of sense. I will cover the reasons in the upcoming videos. The second thing you need to have is you need to have a solid risk management plan, and you have to implement it. And then the third thing is psychology. You need to make sure each one of those plans are followed and executed based on the chart, not based on your emotions or what you are looking for, right? Very important to understand about trading.